Hey everybody, and welcome to this TradeUI options tutorial about how to know what your risk is in regards to options trading in 2020 and beyond. A lot of people don't fully understand exactly what risk they might necessarily be taking. What I personally recommend that you pretty much completely avoid is any margin related plays when you're first starting out with options, because margin plays can hold a lot of risk, especially if you're selling calls or selling puts, that you can be on the hook for that exercise price. And that exercise price can be quite significant, that each contract represents 100 shares. So if you have to follow through with that, you might be on the hook for paying basically the equivalent of buying 100 shares of whatever the ticker. So with SPY or with something else, you'd be on the hook for 300 times 100 of those shares, and so on and so forth. I think you guys get the point of the risk on that end. Of course, the other risk is that shorter term options, shorter term strikes decay a lot quicker. They work kind of like a food, that they decay over time with theta, and that theta can chew up your profits very quickly. So if you're in an option that has a very short term expiration, it's best to be in and out of it, because that decay can get quite rapid, especially towards the end of that expiration day. So if you're buying a same day expiration, that can decline very, very quickly, especially if it even goes slightly out of your expected move. Then you have at the money, in the money, and out of the money. In the money is the only 100% guaranteed value, because you hold that intrinsic value. If you buy an out of the money strike, you basically can be risking 100% of that premium when you buy it, because out of the money only holds extrinsic hype value. There is no actual value tied to it. So if that option gets crushed, basically if the volatility slows down on that given ticker, or even if it just goes flat, you can lose a significant amount of money, even if it's not really dropping or rising, because that risk is based on that volatility. It's based on that movement. So the less of the movement that you get, the more risk you take on those out of the monies. Now, the benefit of the out of the money is that if that out of the money moves to an extreme move to the in the money point, then you could potentially rebound very, very quickly. And then, of course, calls and puts, you take a higher risk doing puts, but some days it can be a higher profit. It all depends on the day. The reason I say that is that generally the market tends to go up. Historically, it's been going up since its inception. Of course, there's inflation and all of that, so some might argue that, but on an overall basis, if you were generally bullish in a swing or a long fashion, you would have made quite a lot of profit if you timed it right, especially on the bottoms in 2008 and 2020. The other risk you can kind of take is liquidity. A lot of people don't understand that there is less liquidity on the smaller tickers. It might seem cheap relatively to get in that, and then you're like, oh wow, I made this much money, and then you try to sell and no one's buying. You need someone to be buying the tickers that you're in. There's a lot of different tickers that come in and out. I generally avoid anything that's not considered a larger cap ticker. Now, some still might get a lot of money flow or whatever. You would want to check the options chain to make sure that you're getting that given flow coming in, and to understand that this is liquid or this is not. Uh, 5-time contracts that were bought in the past week is not very liquid, but if you have hundreds or thousands of contracts, that kind of is. And you have to understand that even if it just shows 50, 100 here, 100 there on contracts, that each contract is worth basically the equivalent of 100 shares. And that means that if you see 50 contracts, they're putting in a lot more than just what might seem like 50 shares. That's 50 times 100 in regards to the amplification because of the contracts. So I hope that clears up some ideas of the risk that you're taking when you're entering. And if you have any other questions, feel free to ask, and have a nice day.